In this lecture, I'm going to talk about revenue recognition. The issues here we'll talk about are what is revenue recognition, this whole idea of IFRS convergence, which is really important in this. We'll talk about some recognition methods and some abuses, and we'll end with a very brief discussion of quality of earning. Revenue recognition is a really critical topic, but my guess is that for a lot of you, you really haven't even heard the phrase before. It's kind of a specialized topic, but it's really critical to analysts. The idea, and I see here with my explain everything, my red lines are moving a little bit from my original slideshow, so bear with me. But the question is whether and when revenue is earned and measurable. And the two key question is, when is it earned and how much revenue? The idea being here that we have this thing called a critical event. It's a point in the transaction process where it's completed, and at that point recognizing the revenue associated. We do have a problem here. It's a really critical issue, but the rules are changing, and it's going to affect you in the early part of your career. In 2014, FASB and IASB agreed on a new set of standards, and it's a big deal. This is going to affect basically everybody on the planet. Public companies in the U.S. beginning in 2017, private companies in the U.S. beginning in 2018. So we do have an issue of substance here. So for folks who are graduating this year or next, we're going to have an understanding of the old rules because we're going to be analyzing historical statements. You got a project to do, and for the first couple of years of employment, these are going to be the rules before the new standards come in 2017. We'll try to give you a flavor for these so that you have a leg up going here. These are the old standards. The old standards are very much industry specific. And so if you went to work for an airline and then in a subsequent job went to work for a healthcare company, the rules would be completely different. They are unique. They came into being as a result of many years of kind of working through this with the accounting profession. And so they're industry specific. That's one of the things that's going under the new system. Let's talk about some methods of reckoning to give you a sense of why this is important. The simplest recognition method is point of sale. So we've been using our old friend Dick's Sporting Goods here. You go over to Dick's Sporting Goods this afternoon. You purchase whatever it is you purchase. You bring it to the front counter. You give them either cash or your credit card. And as you pass across the cash and they bag up your product, the transaction is complete. They record the revenue. Even if they don't get the revenue till tomorrow, or even if you're there for the athletic department of Bryant University that may have a credit account and may not pay them for 30 days. Either way, they're going to recognize the revenue and either record cash or record a receivable for that. Now, in some cases where payment is uncertain, then it may wait until the cash shows up. So if you think about some of these businesses around town that sell used cars and they have big signs up that say, bad credit, no problem, everybody gets a car, well, a significant part of their clientele may not be going to make all of their payments that's there. So when they sell these cars, they can't be sure that the receivables are good, so they may record their revenues when the actual payment is received. You go to some of these stores where there are consignment sales. So if you have a piece of furniture or a piece of clothing and you're going to sell that and you take it to a consignment store, you haven't sold anything until the subsequent consignment store sells something. And so it's not part of the consignment store's real inventory. That inventory remains with the person who owns it, you in this case, from completed contract. Suppose that you're a building contractor and you sign up to build a house and you start that building construction in November and the house is not done until February. Well, if you're using completed contracts, then any of the payments for that house until it's built would be set up as deferred revenue, and any of the costs that you incur during the prior year, they would be capitalized as construction costs. And then in the new year, when you sell or when you complete the house and you get the final payments, then we recognize all the revenue and all the expenses associated with it. That's one method. It might be that the contractor uses a percentage of completion method. And so at the end of the year, they make a judgment about what proportion of the contract is complete and then recognize revenue and expense on that basis. Now, a key question becomes, how do we figure out what the percentage of completion is? Do you have an independent engineer who comes out and examines the thing and says, yeah, it's 50% done? Or do you do it on the basis of the cost that you've incurred? And so we've spent half the money we think it's going to cost to build the house, we must be half done. That's done, but one of the risks with that is that if you're being inefficient and you're spending more money than you should, the cost overruns will be offset in the short term by you recognizing more revenues, and in the second period, when it catches up to you, you take a hit to revenue and to income that's there. So that's one of the analyst issues. Some products get sold with a right of return, and so if we sell a product, but we allow them to send the product back, not just regular warranty, something's wrong with it, but it didn't sell, so here it is back, then in that case, the revenue shouldn't be recognized until we have some idea of how much of this stuff is coming. There are also products, one probably in your pocket, that involves continuing involvement by the seller. And so you buy a phone, the company agrees to provide you software updates for the next foreseeable future for this. And so you're really buying a package of goods and services associated with this. Excuse me. How do you deal with breaking those apart? And then you have contingent sales. So sales that involve a contingency. Yes, we have done this, but you agree to do the following after the quote sale is complete. Well, if that contingency has not been resolved, then the sale is not complete, and it's an issue with revenue. Some adjustments to revenue. Implicit interest. So a lot of furniture companies, you go buy a furniture and you have a year or 2 years to pay with no interest. In that case, you're really buying two transactions rolled into one. One transaction is you're buying the furniture. The second transaction is you're getting a loan. And there's two accounting pieces of that. Everybody who has sales on credit has to deal with uncollectible accounts. And so we set up, and we've talked about this, we set up an allowance for doubtful accounts and write off an expense for that amount. And we can establish the allowances either based on percentages on prior experience, if we know that on average 3% of people don't pay, or for big ticket items, we may do an aging, meaning that we, at the end of the year, we look at everybody and see where they are. And so maybe our terms are net 30, and most people pay within 40 days, and that's okay with us. But we've got a handful of people who are 90 or 100 days tardy. We may take an allowance for those ones that are notably long. That's there. Sales discounts and sales returns and allowances are adjustments directly to revenue, not as an expense item. That's there. Bundles of goods and services. We mentioned the iPhone. This was an issue back in 2009. When iPhone first came out, I think 2007, the accounting rules required them, because they had this deal that for the life of the phone they would update it, and they chose to say, well, typical person will keep their phone for 2 years, so they would recognize the entire cost of the iPhone in 1/8 increments over 8 quarters, over 2 years. And that made a huge amount of unrecognized deferred revenue for iPhone. And they were part of a group that lobbied FASB, and they changed the rules, and now they have this process of bundling. And so you've got a bundle. When you buy a phone, you're buying a bundle of hardware and a bundle of software. Apple attributes most of the value to the hardware, and they set aside a little bit, typically about $10, which they say is the cost of meeting the software requirements over the 8 quarters. So now, under the new rules, they recognize all the revenue of selling the iPhone when it is sold, except for this small minor cost that's there. So a change and makes a huge difference in the amount of revenue that's recognized. Now, what about the new model? The new model is principles-based, meaning that they haven't come out with a whole cadre of specific industry rules, and these industry practices will be gone. On day 1, 2017, they're going to just disappear. Now, over time, there may be some new interpretations, but the old rules are going to go away. And one of the things that we're going to have to, as analysts, are going to have to pay attention to is that when the new rules go in, the metrics that we have been calculating, profit margins, gross profit margins, return on assets, return on equities, they're going to change. And they're going to change not because of changes in economic conditions for the company. They're going to change because the rules have changed. And so that's going to be an issue, particularly as we get started in this process from here. This is compliments of PwC, their little schematic of now what's the new 5-step process for recognizing revenue. This: identify the contract, separate the performance obligations. So if you get the phone with the hardware and the software, determine the transaction price. What price is being paid for each of these components, and how do we allocate it across, and then finally recognize the revenue from there. So 5 that will be applied. The issues that come: identify the contract. Do we have a contract? What is a contract that's there? Identify the performance obligations, and this is an important phrase that's showing up in here. The performance obligations in the contract. What things has to be done by the parties in order to complete the contract there? Then determine the transaction price. Is there a financing component? Is the consideration, the amount that's being paid, is it collectible? Allocate this transaction over the separate performance obligations. So we figured out what the performance obligations are. We allocate these transaction price, the collectible portions of them there, and then recognize the revenue when or as they satisfy the performance obligations. So that's the process. Relatively simple in concept, but going to be pretty substantial as we learn this going forward. Managing the transition is going to be a very serious issue because not only is the accounting going to change, they're going to have to think how they negotiate contracts, because right now contracts are negotiated in order to maximize revenue recognition for a lot of companies. And so you're going to educate your sales force how this is done. Analysts are going to have to be prepared for how the financial reporting will change and how to detect differences to see whether we're seeing changes in business or changes in accounting. So it's going to be a period of some uncertainty here for a while. What kind of abuses occur in this? We've seen some of these, right, dating back to the first day of classes. Channel stuffing. We send a whole lot of product out to try to get revenue recognized early, and we get this one-time boost in revenue, but if we allow that product to be returned, maybe it's not real revenue at all and shouldn't even be recognized in the period that's there. There's some games that are played. This is particularly in technology firms. So suppose that you and I both have startup technology firms that are generating revenue by selling ads. We need to show our investors that we have some good growth in ad growth. It doesn't cost much to run an ad. It's not like saying, give me product hardware to run an ad. It takes a little bit of effort to create the ad, and then it's just shown electronically. So you and I can easily get together and agree that each of us will purchase $1 million of ads from each other. No money changes hands, but I've got $1 million of revenue, you've got $1 million of revenue, and it shows up as revenue, but it's really not an issue, not real revenue. Non-arm's length transactions. This gets into hardcore fraud. Channel stuffing is legal, stupid typically. This is legal, but you got to be careful to look for it as an analyst. But what happened with Enron was that they had phony companies that were set up that appeared to be separate companies, but in fact were the same company, and they were shifting money just from taking a $20 bill out of your left front pocket and putting it into your right front pocket and acting as if you've got $20 new. And obviously don't, and they didn't either. Recording pending sales is a really big deal with this. And so when is a sale complete? And when you're selling things like these complex software, consulting, and these kind of things. So how does this happen? When's the sale complete? When are the goods or services transferred? And when is there a credible promise and ability to pay from here? Some games with gross versus net revenues. When Groupon started, they attempted to report as revenue the entire price paid, even though they're really doing an advertising process, and the majority of the cost of the Groupon, or a significant part of the Groupon, half of it, is going back to the vendor that was there. Well, they were trying to take both parts, even though part of that was clearly the vendor's revenue from. Other consignment sales don't recognize that there's a consignment, and this inventory may in fact revert to its original seller that's there. It shouldn't be reported to revenue until it is sold to the end user, not to the consignor who has the right of returns. We get into some very picky kind of things as well. Some issues of when is the transaction complete? And so issues of what's sitting on a loading dock, whose is it? And you think, well, what does this matter? Well, there was a classic case involving a pharmaceutical company. And if you think about a pharmaceutical company with some of these drugs that are still under patent protection, some of these drugs sell for obscene amounts of money, and so a single tablet might sell for $100 or more. And so if you think about a tractor trailer that is full of large containers of one of these patented drugs that's selling for $100 a tablet, you've got millions of dollars, maybe hundreds of millions of dollars of product that's on the truck. Now it matters if this product is being delivered at the end of a quarter or at the end of a year. If it's on the truck, whose truck is it? Is it only a completed sale when the pharmaceutical company, drops it into the warehouse? What if it's sitting on a truck but parked in the buying company's loading dock area, but they get there too late to unload? These things become real issues in these discussions from here. Deferred revenue recognized. So you go sign up at a health club, and health clubs, by and large, a lot of them make their money early in the year by getting people who have their New Year's resolution, who sign up for 2 years. They work out 4 times the first week, 3 times the second week, twice the third week, and by the fourth week they're never seen again, and all of that money is collected from there. However, properly done, even though they've delivered all the service they're going to do, as long as that deal is that you have the right for that 2 periods, they should only be recognized when that time has elapsed from there. And so there's potential for abuse there. Finally, quality of earnings. I think my lines are kind of a little out of place that's there. Quality of earnings have to do when earnings reflect real and sustainable. And so poor quality of earnings are those that result from changes in accounting policies, when we use a different method than our competitors that are there, or when there's one-time events. We boost revenue by a one-time sale, bringing investment income on a one-time basis. And so we'll talk more about quality of earnings when we get to class. We'll talk a little bit about extraordinary items that affect earnings. This is a change, very brand new. In January 2015, the whole concept of extraordinary items essentially went away. For companies after the end of 2015, you will not see extraordinary items in American financial statements anymore. They're just going to go away in virtually all cases, as I understand from there. Restructuring costs. These are also a significant issue that affects quality of earnings. And so restructuring costs are a separate line item, costs of all of these things that are here, but this is a potential abuse. And if you want to see who does it really well at abusing it, go look at Hewlett-Packard. And what you do is you aggressively capitalize costs, driving up income in the short term. Then you limit your write-offs, increasing your income. Then, a couple of years down the road, you take what's known as a big bath. You have a tough year, and so you write everything off. You tell investors this is a one-time thing, shouldn't be. When you analysts are looking at this, just ignore this because this is not what's going to happen going forward. But then you repeat the process that's there. And I was an article that was in one of the major publications, probably the Wall Street Journal, that talked about how analysts with Hewlett-Packard are just taking those restructuring costs and allocating them back across their regular income because they do it so often that they're. Non-GAAP measures, companies will try to tell you that the GAAP measurements, those are not the ones you should look at. You really should look at these other metrics, and these other metrics universally always show that the company is doing better than the GAAP measurements are. And so in the business, this stuff has become, you've heard EBIT, well, this is EBBS, earnings before bad stuff. And be very, very careful of getting suckered into those that are there. So we've gone through a number of things quite quickly here. Revenue recognition, critically important. When's a sale? Where are the opportunities here? And the changes that are coming are going to affect absolutely everybody. Look forward to seeing you in class.